How do you understand this when the probability of a move is at 28%, but the two-year yield is at 0.8%?
Market's not very efficient. It's not always right. I think this time they've caught it wrong. I think we see a rate rise tomorrow. I think she's talked herself into a position where she almost has to. And you know what? The economy, if she says 25 basis points tomorrow, that's strength in the economy. That's confidence in the economy. That's what the markets need right now. They need a bit of confidence, a bit of stability. I think it would do good to the market to have a rate rise tomorrow.
What would it do to markets overseas and economies overseas, though?
Yeah, that's harder. And I think your point about China is really important here as well. Does it give them space to ease? Does it give the ECB space to actually do more QE? Yes, it probably does, and they need to do it. They know that's coming along. And maybe it moves it forward from later in the year to slightly earlier in the year, in November or maybe October. It's a fine-run thing about the decision tomorrow. I mean, the number of people I've been watching Bloomberg all day, some are yes, some are no, and, you know, whether the market's for it or not, I think the conditions are right economically to go now. If she doesn't go now, she's worried about something else. If she's worried about something else, what's going to change between now and October?
There's always something to worry about.
Yeah, the next 6 weeks, what's really going to change? Yeah. But the real concern has to do, obviously, with global yields. And if you take a look inside my Bloomberg terminal, you have the U.S. 10-year, the UK 10-year, and the German 10-year. And they pretty much move in tandem. Yeah, the German 10-year is a little bit weaker. But if we do see the long end of the curve start to rise, what is that going to do for the global rate environment?
So if we see a rate rise tomorrow, I think we get a rise up the front end. We've already seen that with the 2-year in the last couple of days. Pretty dramatic stuff. I think the 10-year yield, probably fairly static. The long end, the 30-year, might go down a bit. Because they're thinking about this path of interest rates as they go up and controlling inflation when it eventually comes back round. That's actually not a bad thing for the long end of the US Treasury market. You may see mortgages actually fairly unchanged. This might be the biggest non-event that we've been talking about for a long time in terms of the real economy, but she needs to do it. She needs to signal the change in direction.
Certainly, there is the real economy effect as well to consider. We had the Bank of England come out with its decision. No change there. But the language that Mark Carney gave was fairly interesting in that they signaled they're really not overly concerned by the developments in China. Could that be an indicator of how the Fed positions itself?
Well, I don't know how much they talk between Janet Yellen and Mark Carney, but I imagine there is some chat. And at the end of the day, the job of both these central banks is their domestic economy. They're worried about financial market stability, that's important, and clearly the feed-through effect on the economy is important. But you get your own economy right, you get the response right to what's happening at home first, and then worry about everything else later. And I think it's a sensible attitude by Mark Carney, and it's one that Janet Yellen should certainly take a very careful look at.
If you're Mario Draghi, are you able to pump enough money into the system to offset a Fed rate hike, a potential BOE rate hike, a global FX reserves that are falling? Can you do it?
Well, Mario Draghi is very, very good at, close to 60 billion a month that we're getting already. Really good at verbally kind of supporting the markets as well. So I think he can. The ECB's increased its balance sheet by around 2.5 times. During this extraordinary period for monetary policy. Fed, you guys have increased it 5 times. You know, there's scope here to a lot more done. I think it comes down to how much the Germans will live with. The Bundesbank's nervous enough about QE anyway. There's a lot of chat within Germany, and, you know, my boss is a German, and he's always worried about what the ECB are going to do. And I think that's where the tension comes, but there's room for a lot more there yet before it really becomes a problem.
Has some of that anxiety died down, though, as the data show that Europe is doing better after Mario Draghi enacted QE?
Well, I think the anxiety is around the legality of it, rather than it's around whether they should do it or not. I agree with you. ECB QE is having a bigger impact, a lot quicker than the Fed had when it started its round of policy easing, extraordinary policy easing, by the way. This is supposed to be something that happens once in a blue moon. You've got to get out of it. It's another reason, surely, tomorrow.
So how do you position yourself with this uncertainty and with the divergence of this economic policy?
We're short the front end of the curve in the US. So you're short 2 years, kind of neutral 10 years, and we're long 30 years. So we're looking for a flatter curve everywhere. You're shifting your risk assets, so you're putting more money to work in risk assets at the moment. I think if rates go up tomorrow and it's that vote of confidence, I'd rather buy credit. I'm quite happy with buying more high-yield credit as well. The more riskier end of high-yield credit, but probably in Europe. Right? I think the problems in the US high-yield market are well written about and still here. I'd probably go over that side of the pond rather than in the US.
How about risk extending to the emerging markets? What are you looking at in terms of the opportunities outside of Europe, outside the US?
They're there, but you've got to be very, very selective about it. You need to see that policy response from China before you're going to get really invested into emerging markets in a big way from a debt holder's perspective. We've got a little bit in India now. I think that's a really interesting market. The reforms coming through are strong, and you're starting to see an improvement in the sovereign. That's worth a good investment. Maybe around in Indonesia as well, some of the peripheral countries around there. But you know, there's places like Australia that are suffering badly from China's slowdown. That's a good short. Right. If you want to fund your other investments, I think that's a good place to do it.
Last question here. If we do not get a rate hike from Janet Yellen tomorrow, what will markets do as we've seen this rally over the last 2 days?
I think it depends what she says at 2:45. The 2:30 statements are relevant. If she puts rates up or doesn't put rates up, it's all about the statement at 2:45. If it's dovish, it'll support. If it's hawkish, I think it'll support because it'll talk about their confidence, but I think the risks around that are really very, very high now. I think the only thing you can know for sure, more volatility.